Thank you for joining us this afternoon in the Activities Lounge, one of the many lounges at Candlewood House for this virtual Paying for Care event. Candlewood House is TLC Care's brand new flagship luxury care home, which is opening soon in northwest London. And it will provide premium residential, nursing and memory care for self-funding residents across our local communities, which include Hampstead, Golders Green, Belsize Park, Queen's Park, St John's Wood and Maida Vale. Now, we understand that talking about paying for care can sometimes be uncomfortable, so we're opening up the conversation today because this week is Talk Money Week. Talk Money Week is an annual campaign run by the Money and Pensions Service to help reduce the stigma around talking about money. I'm now going to hand over to our guest speaker today, which is Society of Later Life Advisors, SOLA, accredited care funding specialist Nikki Cave, who's the Managing Director of Eldercare Group. So thank you, Nikki.
Thanks, Catherine. Let me, without further ado, switch over to my presentation. And it just seems to be on a slight go slow this afternoon. Hopefully you can see that okay. So that's going to be around half an hour. I'm going to speak to you this afternoon, and as Catherine says, it's a huge topic, a difficult topic. Money and care related makes double trouble really. So I've tried to keep things simple and break this down into the three main questions that we really come across when talking to families. The first being the obvious really, who actually pays for a stay in a care home? Because unless you've dealt with this before, the answer could come as a bit of a shock. We're going to look around whether a property has to be sold to pay for care. There are some urban myths really around this, so we'll take a look at that. And in the absence of any government policy support around social care, let's have a look at whether there's a way to actually limit the cost of care oneself. So a bit of a packed agenda. Don't worry so much about taking notes, or we'll have this available on a recording anyway, but we do have a Paying for Care guide that does cover all of this, and request that by Catherine, and that should really summarise anything for family members that are a bit more removed. Before I look at those three questions, let me just introduce ourselves in a bit more detail. As Catherine mentioned, we are all members of the Society of Later Life Advisors, and that's really just a gold standard for care advice. It's really something any consumer taking advice in this area needs to make sure their advisor has this accreditation. And within the sort of SOLA community, if you like, there are still some advisors that are quite holistic. We, however, specialise just in solutions for care fees funding. So whilst we have the qualifications to talk about mortgages and pensions and life assurance, it's not something we deal with on a daily basis. This, however, all day, every day. So I actually set the company up myself 2007, quite a while ago now. And that was purely as a result of my family's experience of the care system when my grandparents went into care. It really was a case of we didn't know what we didn't know. We had no idea there was advice that would have helped us, so we didn't go and seek it. And that remains the case for most families even today. Once I found out through my professional career that there were solutions that might have helped us, I got quite cross that we hadn't found out. So if you like, this is a bit of a soapbox that I've never got off. Whilst we're here at today, the kind invitation of Catherine, we've worked with TLC actually for a number of years, but we don't have any commercial link with any care provider. So it's just about getting the right information to the right people at the right time. That's what this event's for. Talking about money, you would expect us to be appropriately regulated, and we are indeed directly regulated by the Financial Conduct Authority. And location, even pre-lockdown, isn't a problem for us because we've always delivered our service by phone, post, email, and more latterly Zoom and Teams. The reason we do it that way rather than face-to-face per se, we will always do face-to-face if that's the request, but this way, there is nothing lost in translation. So if there are different members of the family in different parts of the country, here everything is there in writing. There's a clear audit trail because these are important. It's an important topic. So it's crucial, I think, that we have that audit trail. And Eldercare, we're not a charity, but we do a huge amount of pro bono work. So it's our business decision to give free advice, if you like, a free consultation initially, and actually to research some of the financial solutions free of charge, our expense, not yours. We will be paid at a point in the process if someone were to instruct us and implement a financial solution. We're paid an arrangement fee, but that is all disclosed to you and agreed by you well in advance. But certainly initial conversations, guidance and advice, no charge. Back to those questions, let's talk me, let's talk money. Back to those initial questions, let's look at the first one around meeting the cost of care and who pays for it. Because it's, as I say, half an hour, I am simplifying things. So I'm going to talk in very simple terms that funding either comes from the local authority, social services, the council, all the same place. It could come from the National Health Service. But if it doesn't, then the funding stream is that of being a self-funder. So let's pick these off in turn. The local authority funding system, complex as it is, the first thing really to be aware of is that you have to meet the local authority's eligibility criteria first for them to entertain any notion that they might be paying for you. So what I mean by that is if a person chooses to go into a care home rather than needs to go into a care home, perhaps they're feeling unsafe at home and lonely and are making the choice to go into care, then if they have no funds, the local authority simply won't be paying for them. So you have to meet the eligibility criteria, and it's quite a high bar, and it's certainly got higher over the years. So that's first and foremost. Only after a care needs assessment has been done should there be any conversation about the money. That sadly is not always the order of events. Quite often we hear the questions being asked of a social worker, do you have a house, for example, long before any care assessment's taken place. But that's the order it should be: care assessment, financial assessment. And during the financial assessment, what they're really trying to look at, ascertain, is how much capital you have. And told in England and Northern Ireland is not very high, £23,250. And that has changed in the last 9 years. So in real terms, that's going backwards. 50,000 is the limit in Wales, so much more generous there. So that's what they're looking at. Do you have above or below? What do they take into account as capital? Well, I could be flippant and say pretty much everything, but there are some notable exceptions. The first, if you're a couple, then they can only look at half of anything that is jointly owned. Okay, so anything that your spouse remaining at home owns in their own name, that is disregarded, and 100% of anything that's owned solely by them, as you might expect. It's the individual that's assessed, not the couple. The property, the family home, if again in a married couple scenario, if the spouse is remaining in the property, it is disregarded as far as any assessment of the individual going into care. You would hope that, but again, we do hear families being told otherwise by social services, which is a concern. If a relative over 60, there's a couple of other exceptions as well, but these are the two common ones. If a relative over 60 lives in the property, it will also be disregarded. However, if daughter age 62 moves into the house just as mum or dad is moving out into care, then that disregard won't apply. The local authority might think that the system is being cheated somewhat, and they will just call that deliberate deprivation. That's a term they can use for anything that they feel is being done to avoid spending something costs. That won't wash, but a genuine cohabiting arrangement, a relative over 60, the property will be disregarded. Okay, so you would expect that, but I'm having to point that out because it doesn't always happen. The other notable exception doesn't apply to everybody, but I often come across families that it does relate to, is if the individual has invested in investment bonds that include life insurance over the years. How would you tell if a relative has one of these? Well, the paperwork normally would be from an entity, not Abbey National, Barclays, Lloyds Bank. It would be more like an Aviva, Standard Life, Scottish Widows, something of that order. The policy documents would actually refer to Mr. and Mrs. Smith, lives assured, and it might even talk about units the value of the bond going up as well as down. So it's a really weird exception. Why? I don't know. It goes back to some legislation from the 40s, but at the moment that is the rule. It is disregarded. Someone could choose to use the money and encash it to pay for care, absolutely. But what we're saying is you don't have to, so don't rush to do it before you've taken advice. Okay. Income also counts. It's also a factor when someone is getting funding from the local authority. If there's a spouse, then the rules are slightly different. You are expected to contribute your own income towards what the council will pay for you. But if you have a spouse, you can pay 50% of your private pension to them. Otherwise, pretty much all that you have goes towards what the local authority will pay. So it's a combined effort, not here's what they will pay and here's what I can pay on top. It's a combined contribution when they state what the amount is, and they will have a limit on what they pay. Now, that's not meant to be an arbitrary predetermined amount. They are supposed to assess a person's need and then meet that need by offering a care home place, a genuine care home place that meets the person's need, and that they, as the council, will fund in full with no requirement for a top-up, just the contribution from pension from the individual. So they can't really just give a list and say, go and find one, and everybody says we require top-ups. There has to be one that doesn't require a top-up. Now, if the home that is on offer is not the one that you want and you want to go to somewhere else, that's absolutely fine. But in that instance, a third party, could be your spouse, could be your children, then they might be required or asked to pay a third party top-up. So that's the only time that should happen. That's our sort of means-tested social care system, a whistle-stop, as I say, obviously much more confusing and complicated than that, but we'll give you hopefully a flavour for the purposes of today. Then running parallel but separately to the local authority funding stream is the National Health Service. And if your needs are much more for healthcare than personal care, and those healthcare needs are complex, unstable, unpredictable, they're the sorts of words that are used. If you meet certain criteria, then the National Health Service will pay for you in full. As you can imagine, quite difficult to get. We can put you in touch with people that can support through a claim there, and much of it actually is about the process. Was the process followed? So it might be something that doesn't feature early on in a care journey, but could feature later. And I always think about this really in terms of the sort of care needs that would ordinarily otherwise be met in a hospital. There they would be paid for by the NHS, so why should that change just because the setting is different? So that's really how to think about it. Again, urban, some people hear about this and think they could qualify for it when it's very, very obvious that they have personal care needs, not healthcare needs. So that's really the distinction there. So finally, on that third category, if you're not eligible for the state funding, the local authority because you have too much money, and you're not eligible for the NHS funding because you're not poorly enough, that's what really puts you into the category of a self-funder or a private fee payer, and you do have to fund the care yourself. The only bit of good news really this afternoon is that you can still claim or retain attendance allowance. Not a huge amount, but it's something. It's tax-free, it's not means tested, doesn't need to go onto a tax return, and it's payable at one of two rates. Normally, if you're in a care home, it is the higher rate because the definer is needing at least 20 minutes of attendance during the night. So it's a big form. We've got a telephone number in our guide for you to be able to claim from that number. As I say, does require a bit of effort to complete, but if you think about what they're actually just looking for, most people in a care home will get it and will get that higher rate. The only time that stops is if you stop being a self-funder. So if the local authority take over your funding, the attendance allowance will stop, or if you're in hospital, it will also stop. That's the good news. The only other help really available for self-funders is some of them, if they have a property and that's their main asset and it's being left empty when they move into care, then they are eligible normally for something called the 12-week property disregard. Again, it's a real, it actually is quite complicated because local authorities don't seem to be able to clearly make that distinction between a self-funder, state-funded. They can't quite work it out sometimes, and there's misadvice because really it's a self-funder who's local authority funded for a short period. So the property value has to be ignored for the 12 weeks. You still have to meet the eligibility criteria, money under 23,000, and they will only pay their state rate, whatever that might be. So the care home is perfectly at liberty to charge a top up during that 12-week period. And the one exception to the rule is that you can be your own top up in this scenario. So if you have got 20,000 in the bank, you can use that to be your own top up during this 12-week period. And then the notion of the 12 weeks was really to give people time to think. We said earlier at the beginning, do you have to sell your property? Well, this was designed really to give you some time to think about it. So at the end of the 12 weeks, most people haven't either fully decided what they want to do, or if they are selling, they perhaps haven't sold yet. And you wouldn't be able to get, for example, any kind of equity release mortgage on this property because it's no longer owner occupied. So your options become quite limited. So for that reason, there is, I call it a local authority equity release for want of a better description, but there is a deferred payment agreement that is available from your local authority. It's mandatory for all councils to offer this, okay? Now, if the property wouldn't be lent on by a normal lender because it has structural problems, then fine. But all else being equal, subject to you still meeting the eligibility criteria and having less than 23,250, then they need to lend you the money until your property either is sold or you might decide not to sell it and rent it out. So that could be a solution for some. You would need to take advice around the tax implications and so on and so forth. There's quite a lot to think about around renting a property. But if the most important thing was to not sell the property during mum or dad's lifetime, this is a way of achieving that. So it would need to be sold to pay back the debt at some point, but not during your loved one's lifetime. Interest is payable, but less than 2% and only on the amount that you're borrowing. And you don't actually service that loan. You don't make monthly payments like you would do with a mortgage. It does just roll up. We touched on this. You still need to meet the criteria and have less than the threshold. But the difference here is they can lend you the full fee. So whatever you're short by, once you've allowed for pension and attendance allowance and maybe rent, whatever you might still be short by, that's what the council can lend. As long as there's enough equity in the property to cover that debt for a couple of years at least building up, there is no reason for them not to offer that. And it follows on from the 12-week disregard. 12-week disregard money does not have to be repaid. This does. So absolutely not for everybody, but that myth that you sometimes hear, the newspaper headline, however many houses have to be sold to pay for care. I agree, it will still need to be sold at some point, but not necessarily during the person's lifetime. And that rental income can shave quite a lot off the fees. So always worth discussing. That's an option we would talk to families about and rule it in or rule it out. So moving now to the broader self-funder category, that's people that perhaps have sold a house or have got other assets as well, savings and investments. The families that we've spoken to over the last 15 years, really narrowing it down, there's just two main concerns that the families have. The first is, how do I work out if I can afford this care home if we don't know how long mum or dad or auntie or uncle is going to be in the home? We don't have a crystal ball. That would make cash flow forecasting a lot easier. And if we don't know how long it's going to last, what happens if it runs out? What will the situation be? Will the local authority step in? Will the care home accept the local authority funding? It's a huge area of worry, not to mention the beneficiaries of the will. Will there be anything left for them? So they're the two concerns, the main concerns. And actually, there is a solution that could address both of those. And harping back to my family's situation and my grandparents, this was the solution we'd quite like to have known about back then. As I say, it's not a panacea. I'm not suggesting for a minute it's for everybody. There are many scenarios where it's not appropriate. We might tell families work for them, or we would advise against it. The issue is simply around knowing about it. And I think this is a shocking statistic, and it's why I do what I do. 85% of families for whom this could be a good solution could take away that worry. They never get to hear about it. Now, I don't know whether that's everyone in the chain assuming that somebody else will have told them, or it's people in a position to tell them don't know about it either. Haven't quite cracked the mystery, but it's 85%, and that hasn't changed since I've been advising. So the purpose of today and Talk Money and awareness is to make sure you're no longer in that 85%. So what is it? I'm assuming you don't know, otherwise you might not be on the webinar. But it is a way of capping costs yourself. As I say, the government did bring in a care cap, believe it or not. It was meant to come into play this year. It was in legislation, but it never happened. Even if it had happened, the small print of it meant that most self-funders were unaffected by it for at least 4 or 5 years. So really read the small print if another cap comes in, and we certainly recommend taking action yourself rather than relying on any government to bring in a solution. So normally with insurances, which is fundamentally what this is, you can't really do them after the event. Ordinarily, you'd have to do it in advance, wouldn't you? You wouldn't expect to be able to insure a car after an accident or insure a house after the bathroom ceiling's caved in, yet here you can insure care home costs at the point of moving in or even after you have moved into care. Ironically, you can't insure care home fees ahead of time. You did used to be able to. There were pre-funded products on the market, and if you had one, it will still be valid, but you can no longer buy them. So the insuring after the event is the only option for care fees. Now, the technical term for it is a care fees annuity, but the word annuity is not a good one. People have negative associations with that, arguably rightly so. It was something you used to have to buy. No one likes anything that's compulsory. You used to have to buy it when you retired, swapping your pension fund for a guaranteed income. But you didn't tend to get very much of an income, and that was because these products were expected to pay out for maybe 30 years. If someone was retiring at 60, they might be expected to include a widow's pension and have indexation and all these bells and whistles. So what you actually got as an initial income was quite poor. But if the concept of it, paying a lump sum up front, swapping that for a tax-free income, might that work in this scenario? So if we were to look at somebody's care home fees, work out how much income they already have that they can put towards it, leaves us with a shortfall. If we were to look at a product where a lump sum could be paid that would generate enough to fill that gap, fill that shortfall for life, that might address a couple of those concerns that we looked at. Good news about these as well is that they are individually underwritten, so no rate tables. Everybody's given an individual price taking into account their age and all their health conditions. So the older you are, the cheaper one of these would be to buy, and unfortunately the more poorly you are, the cheaper it would be to buy. That's actually the complete opposite and converse of what we're used to, isn't it, with life assurance policies and things that you might buy earlier on in your life. So it actually financially is better for you to be poorly in this context. So every case is different, individually underwritten, and that's why it's really difficult when people say to us how much will it cost for us to say with any certainty. They are fully portable, so should you move from one home to another or from care at home into care, then it can be taken with you, and you can make provision for fee increases. You don't have to. If there's enough money left over or other investments that are generating income that could cover fee increases, that's fine, or you can build it into the plan. So it just becomes a choice and about balancing risk, really. I do use the term gamble when describing these policies to people because that's what the downside is. The gamble is that you could buy one, pay a large lump sum, and then if the person doesn't live as long as the insurer predicted, in ordinary circumstances, you wouldn't get anything back. So they pay for life. They are guaranteed whether that life is 1 year or 10 years. But if you've bought a policy based on, a 3 or 4 year life expectancy and the person's in care for just 18 months, I absolutely understand why families might be put off by that, although many families actually view it as mum or dad's money for mum or dad's care and c'est la vie, but not everybody does, and I appreciate that. So there are things to do to try and mitigate that. You can pay for extra capital protection, or you can buy these plans on they call it a deferred start date basis. You don't get any benefit for a year or two, but they start and then pay for life. They're much cheaper to buy. So you are losing less in the event of an early death. So that's a form of capital protection in itself. And we will advise on the full range of these options. Okay, so they're all explained in our report and they're all costed as well. Obviously, we're in difficult times now. There's obviously other things and other factors to worry about that we didn't have before. So the insurers have recognised this, and 75% of them will now be offering a COVID-19 money back guarantee, which is outside of their normal ones. If a death were to occur in the first 12 months, the first year of buying a plan, and the COVID is a word on the death certificate, then there's all of the money refunded to the estate, the entire purchase price refunded, less anything that's already been paid to the care home. So there's some extra guarantees, if you like, peace of mind built in at present. So it's about balancing risk at the end of the day, and one easy way of taking one major concern is what happens if the insurance company goes bust. They're protected, these plans, by the Financial Services Compensation Scheme. So that's the same scheme that covers your money at bank. At bank, it's limited to 85,000, not so with these plans. So they're actually safer in that regard, okay? So really two main reasons families are interested in this. The first is to ring fence the remaining assets. Now, even if someone is uber wealthy, if they're uber wealthy and they have an inheritance tax liability on their estate, then this is quite a neat way to bring that inheritance tax bill straight down, because any money spent on this is outside of the estate immediately and the income is tax-free. But also, even if people are moderately wealthy and aren't worried about the money running out, many families still prefer the idea of paying a finite one-off cost up front and knowing that the rest of the estate is completely ring-fenced. So that peace of mind. But other families are doing it really just to avoid that worry, the scenario of knocking on the local authority door and asking for funding and not being too sure what might then fold. So they're the two main reasons. Just as a question that some people might be thinking, but you mentioned that NHS funding earlier. What if my loved one qualifies for that after they've bought one of these plans? Well, it just pays to their bank account rather than to the care home. They don't really need it anymore, but they'll still receive it, and the savings are building back up in that scenario. So I mentioned earlier, it's our business choice to make no charge for researching the option. We have a really streamlined process that we've honed in over the years, so it's not that onerous for us to get the information to you. We just want to make sure there aren't barriers. The number of people that have said, oh, I don't know, I don't think it's for us, and then when they get the report and they compare it with the alternatives and they see the small print and take the time to understand it, many of them actually do take that as a solution. So we're trying to remove the barriers by putting no charge in for the research, but we will be paid a fee if the purchase is made. That's already priced into the quotes that you get. And if it is slightly higher than perhaps a generalist IFA or a more holistic advisor, there's actually a reason for that. We're a specialist, so you would expect to pay for specialist knowledge. But also, on the open market, your advisor, if you find a care advisor, will get quotes from Aviva, from a company called Just, and from another household name called Legal & General. So all care advisors have access to those. Legal & General actually chose us to pilot their product with a couple of years ago. So we did have an exclusive with them for a while, but they then went whole of market. This fourth company, however, National Friendly, based in Bristol, 150 years old, they came to market last year using us again for the pilot because of our specialist knowledge. They now remain exclusively available through ourselves. Now, we never know which of these four will offer the cheapest quotes, so it's really important to get all four. Price difference can be thousands of pounds, which does mean if we are a little more expensive than others, and I'm not saying we are, but if we are, then it kind of pales into insignificance if the National Friendly is £10,000 cheaper. for example. So that's your sort of whistle stop really through the solution. You're now no longer part of the 85%. It might not be of interest, but you may know somebody that should know about this, and at least we can tick that box. What I haven't been able to tell you this afternoon is what one of these would cost, and that's because you all have different scenarios, a different aged relative with a different income and perhaps different care costs. But to try and help, because I know that sounded like a sort of politician approach, not to give you a straight answer, to do a much better answer, we've built a care fee annuity calculator on our website. So with 3 pieces of information, the age of the person, the cost of the care and income, this will give you a guide price. It really is an estimate, but it's an estimate based on all the quotes that we've obtained over the years for our clients. So we're pretty confident it will be within range. If the person is under the age of 80, we would rather discuss it over the phone because the data is a little more limited. So the calculator won't work if your loved one is under the age of 80. But hopefully that will help. There's a lot more information on there as well, as I say, including the guide. And as Catherine said earlier, it's just about understanding. I'm a firm believer of knowledge is power. And if you understand all of this, what your options are, it could lead you to choose a home that you might otherwise dismiss based on cost. It's always worth investigating and having a conversation with an expert such as ourselves. So I shall, without further ado, stop presenting, and hopefully that will put Catherine back onto your screen. There you are.
Thank you very much, Nikki. That was really interesting and really helpful. And we'll be sharing that information on our social media. And if anybody does want to get in touch with me to learn more about Candlewood House, they can call me on 0203 893 2929. Or book a tour via our website. We are actually doing tours of Candlewood House at the moment, pre-opening. So I'd be happy to bring you in and have a look round. Thank you very much for your time this afternoon, and we look forward to speaking to you soon.